JD.com Inc., trading under the ticker JD, is currently sitting at $31.00, reflecting an intraday dip of negative 0.79% as of 11:45 a.m. Eastern Time on this Thursday, November 13, 2025. Now, the common expectation for a stock that has been beaten up for the last year, hovering near its 52-week low of $29.90, is often a muted reaction to anything but absolutely stellar news. Today, however, we see a crucial tension. JD.com just announced its Q3 2025 results, and while the headline numbers look like a beat, revenue came in at $42.0 billion, a 14.9% year-over-year increase, ahead of expectations. The stock is trading. JD.com Inc., trading under the ticker JD, is currently sitting at $31.00, reflecting an intraday dip of minus 0.79% as of 11:45 a.m. Eastern Time on this Thursday, November 13, 2025. Now, the common expectation for a stock that has been beaten up for the last year, hovering near its 52-week low of $29.90, is often a muted reaction to anything but absolutely stellar news. Today, however, we see a crucial tension. JD.com just announced its Q3 2025 results, and while the headline numbers look like a beat, revenue came in at $42.0 billion, a 14.9% year-over-year increase, ahead of expectations. The stock is trading slightly down. This initial downward pressure immediately raises the question, why is the market hesitating on an earnings beat? The subtle, deeper insight here is that the market is focusing less on the top-line beat, which is heavily influenced by the firm's historical strength and the timing of China's Singles' Day shopping festival, and more on the significant cost structure changes and the declining net income attributable to ordinary shareholders, which dropped from RMB $11.7 billion last year to $5.3 billion this quarter. The reality is that the aggressive push into new, less established, and highly competitive segments like food delivery is eating into profitability even as revenue accelerates. That's the core conflict we need to understand: growth versus margin. The prevailing market narrative around JD.com over the past few quarters has been one of a stable, logistics-heavy, quality-focused e-commerce player that has been relatively safe amidst the broader volatility and regulatory uncertainty impacting other major Chinese tech stocks. Investors who look at JD stock often point to its self-operated supply chain, JD Logistics, as a substantial competitive moat, especially compared to asset-light rivals. They expected the core retail segment, JD Retail, to deliver steady if unspectacular growth with expanding margins. The expectation was that management would prioritize efficiency and capital returns, leveraging the firm's maturity. This expectation for stability and improving core profitability is precisely what is being challenged by today's reality. While the core JD Retail segment did perform well, reporting an 11.4% revenue increase and an expanded operating margin of 5.9% compared to 5.2% a year ago, the overall non-GAAP net income per ADS fell sharply from RMB 8.68 to 3.73 RMB. This is a staggering drop, one that cannot be ignored simply because the revenue number was slightly better than anticipated. The market is processing the fact that the fulfillment expenses surged by over 35% and, perhaps most tellingly, marketing expenses more than doubled, increasing by 110.5% year-over-year. This colossal increase in marketing is primarily tied to the aggressive expansion of the new business initiatives, particularly the foray into the highly subsidized and cutthroat food delivery space, which is an explicit strategy to gain market share in high-frequency consumer spending categories. This kind of investment spending is necessary for growth, but it directly contradicts the expectation of an immediately visible return to a margin-first operating model. The volume on JD stock today, which is already approaching 12 million shares in the morning session, suggests a high level of institutional churn as firms reevaluate their positions. We see names like FMR LLC and Lazard Asset Management LLC having significantly decreased their holdings in the last quarter, while FIL Ltd has added aggressively, highlighting the fundamental disagreement among large funds on this exact point of investment versus profitability. Are these heavy investments necessary to maintain long-term relevance, or are they an expensive detour? This is what investors using platforms like Interactive Brokers for active trading are debating right now. A deeper look at the daily technical action on JD stock reveals that the share price opened higher this morning following the earnings release, but immediately faced selling pressure, indicating that the initial enthusiasm for the revenue beat quickly dissolved as the details of the cost structure were digested. The high-volume selling near the open suggests institutional players use the initial price pop as an opportunity to offload positions. The stock is now testing a key short-term support level just above its 52-week low. The sheer velocity of the marketing spend is the central issue. A 110% increase in marketing expenses is not a sign of a steady, mature business looking to optimize. It is the footprint of a firm deliberately sacrificing short-term profitability for market penetration and future optionality. Management is clearly trying to widen the firm's growth drivers beyond its traditional strongholds of electronics and home appliances. They are attempting to invest online in a larger share of the Chinese consumer's wallet, specifically in the general merchandise category and the fiercely contested food delivery and fresh produce segments, where the competition from PDD Holdings and Meton is relentless. This kind of competitive environment necessitates the massive spending we're seeing, which also contrasts with the more conservative, cost-conscious approach we've observed at U.S. counterparts like Apple stock or Tesla stock in their core segments, where they often enjoy clearer competitive advantages and pricing power. Even an aggressive tech investor on a platform like Robinhood would have to appreciate the high-stakes gamble inherent in this strategy. The trade-off is clear. The revenue growth is the proof that the strategy is delivering top-line momentum, but the sharp decline in net income shows the price of that growth. The market, which has priced JD stock for a stable value-oriented profile, is now forced to re-rate it as a growth stock with high associated risk, which is why we see the selling pressure today. To grasp the full picture, it's essential to understand what JD.com is at its foundation. The company is, first and foremost, a supply chain-based technology and service provider, operating largely through its JD Retail, JD Logistics, and New Businesses segments. Unlike marketplace models that simply connect buyers and sellers, JD.com operates on a direct sales model for a significant portion of its products, managing inventory and logistics end-to-end. JD Logistics is a major differentiator, a vast network of warehouses and a dedicated delivery service that allows for rapid and reliable fulfillment, a competitive edge that is nearly impossible for competitors to replicate quickly. This integrated logistics backbone is the bedrock of its higher service quality and customer satisfaction, which forms the basis of the historical bullish argument for the stock. This business model, focusing on controlled quality from procurement to the last mile, tends to generate higher product margins in core categories like electronics. In the past, this structure allowed JD.com to consistently deliver robust operational cash flow and a clear path to profitability even as it scaled. However, the recent strategic shift is leveraging this logistics strength to support businesses far outside its core, which dilutes the immediate margin benefit. The company's push into new physical stores, JD Mall and JD Appliance City flagship stores, is another key element of the current strategy, which requires substantial upfront capital expenditure, further weighing on near-term free cash flow, even as the company's buyback program continues to signal confidence to long-term investors. A comprehensive investment strategy requires understanding these internal shifts, whether you're using a full-service platform like Fidelity or managing a more algorithmic strategy through Schwab Intelligent Portfolios. Drilling down further into the recent financial metrics from the Q3 report, the performance of the core JD Retail segment with its operating margin expansion is a definite positive. This shows that the original profitable engine of the company remains fundamentally healthy. The increased focus on the general merchandise category and advertising revenues within JD Retail are cited by management as the key future growth drivers for the segment, which is a sensible pivot as the electronics market matures. The strategic value of this lies in increasing the frequency of customer engagement, a metric vital in e-commerce. The widening gap, however, lies in the new businesses segment, which contains the high-cost initiatives like food delivery. While the company stated that the food delivery segment recorded steady growth in GMV and order volume, the financial model remains expensive. The goal here is clearly to use the food delivery business as a hook, a high-frequency, high-engagement service that can bring customers to the JD ecosystem and cross-sell them into the higher-margin core retail products. It's a classic platform strategy, but one that is exceedingly expensive to execute in a market where rivals are already deeply entrenched. This is the source of the market's current anxiety and the reason for the downward price action despite the revenue beat. It's a question of faith. Will the cross-selling mechanism eventually convert the high marketing spend into durable, high-margin retail sales, or will it remain a permanent drag on company-wide profitability? The long-term investor or someone utilizing an intelligent portfolio approach must weigh the potential for increased market share against the guaranteed erosion of immediate earnings.